everyone. It's John Llodra here, one of the co-founders and partner at New Harbor Financial Group. I'm here for our weekly market and client update. And again, our purpose here is to bring some data, some insight, and all for the purpose of helping our clients and our viewers to hopefully live secure and less stressful financial futures. It's no small task. We got a lot of challenging things in front of us as consumers, investors, and certainly us as investment managers. So that purpose of a secure and stress-free financial life probably hits home for most folks most profoundly in the sense of their worries about will they have enough money during their lifetimes to support their needs. Most of us work for a good balance of our life and make some sacrifices and hopefully put some money aside to save, all in the hope that someday we can retire and create our own paycheck, so to speak, from those savings. And that's a constant area of stress for folks, our clients, of course. And sometimes that stress is unfounded because they've saved plenty of money to provide the kind of lifestyle that they live. But nonetheless, we as humans, we fear these things, and it's understandable, especially with the stew of things that we face with an uncertain future at any point in time, especially as of right now. Today is February 16th of 2024, so I don't need to elaborate all the kinds of factors that work into that calculus in our minds. But so when it comes to living expenses, one of the most important data points in economics is what we call inflation. And not only what inflation is now, but what is it likely to be over the long term? And this is a tricky area because there's all kinds of techno speak, I should say, as relates to inflation. And frankly, the so-called authoritative sources for inflation are government statistics and data sources that, for most everyday people, don't seem to speak the real truth about what they see in their daily lives in terms of their cost of living and things on the grocery store shelves or gas prices at the pump or housing prices or rent prices. So it's a real important area for folks to think about and try to cut through the mud, if you will, to get a true picture. So I'd like to spend a little bit of time here today talking about some of the kinds of inflation measures that are out there. Try to hopefully bring them down to layperson's terms to just understand what you might see on the headline news, and bring it back to some practical conclusions and maybe some myth busting insofar as what are the ways to combat inflation from an investment standpoint and that kind of thing. So without further ado, let me just cover some of the basic measures of inflation. Okay, so this slide covers the basics of inflation. So generally speaking, there are measures of price inflation in the context of what consumers pay, what you as a consumer pay out of your pocketbook, so to speak, for the things you need in your life. Okay, and there are a couple of key measures there. One is the Consumer Price Index, CPI. Okay, and this is a data point that flows through a number of important things in personal finance, not the least of which are, for example, Social Security payment annual cost of living adjustments. That is driven by CPI. For folks who have pensions or even maybe long-term care insurance policies that have inflation adjustments, oftentimes that's keyed off of CPI. Okay, and from an investment standpoint, things like Treasury inflation protected securities or I bonds, CPI flows into the adjustments in those investments. Another measure of inflation is called the Personal Consumption Expenditure, PCE index. And this one's important because this is the one that the Federal Reserve uses as its primary benchmark of inflation in setting the all-important tone on interest rate policy and things like that. And I don't want to get into too much detail, but some of the key differences between the CPI and PCE are the weights of different inputs. So for example, PCE, I think, has a lower weighting of housing costs than CPI, okay? And the other thing is PCE is driven off of the GDP report. So it actually captures arguably a much broader basket of expenditures that consumers typically will consume in the modern world as opposed to CPI. And there are a whole bunch of other differences there that are beyond what I want to get into today. But this is the key one in the sense that this is what drives federal rate policy, presumably drives Federal Reserve policy. And that has all kinds of ramifications for markets and interest rates and things like that. The other thing I want to call out here is core versus headline. We'll talk about that in a minute, but headline is basically just as the name suggests, it's the raw data for the CPI or PCE. Core basically is a governmental massaging of those data points to remove what might be considered volatile type of measures that can fluctuate seasonally and create in the government statistics mind noise that maybe hides the true rate of inflation. And conveniently, some of the things that are taken out for core are some of the things that are most important to us, things like food and energy. Okay, so big philosophical debate as to whether reporting on core inflation even truly reflects what consumers are incurring, because of, again, some of these adjustments, food and energy, for example, are really important things to live and survive in this world. The other side of the coin, in terms of measuring inflation, is prices paid by producers. Factories and manufacturers of the goods that we consume have to pay for commodity input prices. And the thinking is if those prices are going up, those costs have to be passed on to consumers and ultimately flowing through to these consumer indice measures. Okay, and of timely debate, and this is always fertile ground for political wrangling, the inflation rate and consumers' pocketbooks. Ultimately, our politicians on both sides of the aisle pander to voters to try to win votes, influence their perceptions, and things like calls for calling out of manufacturers for shrinkflation. While that sounds good and convenient for the times we're in, the fact of the matter is that sometimes the prices on the inputs for manufacturers do go up. In fact, just today, the PPI index, again, this is February 16th of 2024, the PPI index came in hotter than expected, stickier than expected. And this is roughly a week after the CPI also came in hotter or stickier, higher than expected. So it's become a bit of a murky picture as to whether inflation rates are truly continuing to soften or they're starting to stall and maybe possibly even turning out. So the question is, what is the true inflation rate? Again, I think people, everyday people in the real world know what their costs are doing. They know what's happening to their pocketbook and their discretionary savings. And these government statistics are wrought with all kinds of data issues, things like survey flaws. Much of the inputs here are based upon surveys, and if you don't have a good survey sample or response rate, you might as well throw the data out. There are things like seasonal adjustments. There are hedonics, what are called hedonics in the world of economics, and that's basically to say that, I'll give you an example of a car. Today's modern cars are filled with all kinds of gadgets and technologies. Even though the cost of a car may have gone up, hedonics will say, well, because there's so much more value in the car of all these tools and technologies, the actual cost of the car has not gone up as it might appear because there's more value for the price, okay? And then there's, of course, mistrust in politics. I guess at one point I wanted to make there is there's all kinds of data you can see on the news, and frankly, it's wrought with problems, it's wrought with conflicts, it's wrought with spin and that kind of thing. And the question is, what is the true inflation rate? We all know as consumers what it feels like our true inflation rate, and every individual arguably has their own inflation rate given their lifestyle and their basket of goods and services that they purchase. I do want to call out a website that certainly we are aware of, but haven't really spent a lot of time. And it's a website called Trueflation. And again, we haven't played around with this much, but it's making waves because it actually has a bunch of resources that are attempting to try to cut to the chase as to what is the real inflation that real people incur at any given point in time. And there is this kind of calculator, personal calculator, where you can plug in some different budgetary items in your own personal income statement in terms of expenditure. So I thought I'd call that to your attention and hopefully give you an ability to kind of get a sense for what your true inflation rate. So again, this inflation is a political football, and one thing we know is that there are always attempts to spin this data for political or otherwise gain. And I just want to share an example of that. This is a tweet that was put out by Paul Krugman, who is a Nobel Prize-winning economist, very widely followed. We here at New Harbor don't necessarily see the world in the same lens through which he sees it. And this tweet is one very good example of it. So this is a tweet that goes back to the fall of 23. And you can see this is a graph that he put out there, which is consumer price index, excluding food, energy, shelter, and used cars. I don't know who on this planet needs food, energy, shelter, or used cars, but if you take those important things out, we saw a dramatic drop in the 6-month change in inflation. Of course, this tweet was essentially a victory lap. That tweet got a lot of flack, understandably so, from the general public, because it couldn't have been more out of touch, we think, and certainly the general public thinks that, with the realities. Those are the kinds of things that people really spend most of their money on, most people. And this is not about people who have assets versus those that don't. These are basic living expenses. So it's no wonder that this is a confusing topic for people, and basically it speaks to the mistrust and the feeding of fears about can I provide for myself during my retirement, knowing that we don't know what the future cost of the things we need will be. So as I mentioned, recent reports. After several months of declining inflation readings, both in CPI and PPI, or PCE and CPI, just in the last week, today, we had a hotter than expected PPI, Producer Price Index report, and last week, a hotter than expected CPI report. So let me show you what this looks like in the big picture. This goes back to, I think, sometime in the 60s, I believe, here, long time. And you can see right here, this here is this year-over-year change in CPI. And this is the inflation spike that we saw in 2021 that peaked in mid-summer of 2022 and has come off that level since then. Okay, and this is actually a little dated, this chart. There's actually been more of a sideways move here. But the point is, we've kind of seen a CPI stall. But the politicians are claiming victory, as I just showed you that tweet by Paul Krugman, because we've seen this rate of annual increase drop suddenly. But please understand that that's a rate of annual increase. It doesn't mean that prices are dropping. In fact, if you look at this chart, the second chart, this is the actual measure of the CPI. Now, maybe the year-over-year rate has slowed down, at least in recent months, but it doesn't mean prices are dropping. In fact, they're continuing to rise. And in fact, they rose most substantially recently, just in the spike in response to COVID. And that's what arguably caused this inflation. And the bottom line is, what has the purchasing power of the U.S. dollar been? And this is a graph showing starkly what the decline in the purchasing power of the U.S. dollar. That went from over 300 to 32. That's an index of purchasing power. So one thing we know for sure is that any inflation, however small, works to erode the purchasing power of your hard-earned dollars. So this is a real issue. Politicians will celebrate inflation coming down, but they conveniently leave out the point that actually prices are still going up. In fact, it's a central part of Federal Reserve policy to have a target inflation rate of 2.2% a year. And there's already talk about them maybe raising that because they're having a hard time maybe getting it down to that 2%. So it's a really tricky thing. Bottom line, consumers, you need to make sure that your assets and investors, that your assets can keep pace and outpace that inflation. And it's not an easy task, as I'll show you in a minute. One of the analogies that are being pointed to is the 1970s as possibly a model for what we may see in this episode with inflation. And basically in the 1970s, I'll show a chart in a second, we had three separate and increasingly difficult bouts with inflation over the span of the late 60s to the early 80s. And that was a real problem. It was a problem for financial markets, it was a problem for consumers, and it was certainly a problem for policymakers. Basically when Paul Volcker was brought finally into the mix as the Federal Reserve Chair in the late 70s, early 80s, he basically had to do the hard thing. He had to push the economy into severe recession, markets into a severe downturn by raising the interest rate, short-term interest rates, got above 20% for a short period of time, all to nip what was a really intractable problem with inflation. Again, the chart of the 70s inflation, 68, we had this first bout of inflation, it cooled. Again, this is the year-over-year change in inflation. It cooled. I'm sure there were victory laps being taken right there, just like that Paul Krugman tweet. Then this more profound bout with inflation here in the 73, 74, 75 timeframe, pulled back again, probably victory laps again. And then this one was really what put the straw that broke the camel's back in the early 80s. And ultimately that was whipped, but it was only whipped by massive rate increases and a pretty nasty recession and stock market sell-off. This next chart brings it to the practical realities of you investors and our clients. How does one invest for that? And this is a really interesting chart that looks at the returns for different asset classes in the 70s. And you've got things like commodities over here, and then you've got bonds and stocks here. So the kinds of assets that most people invest most of their money in, some mix of stocks and bonds, if the 70s are any guide, so this shows both nominal returns that you might see on your statement, then real as adjusted for inflation. Again, real returns are the ones you get to spend in terms of keeping pace with inflation, or hopefully keeping pace. But what we saw here in the 70s is that the assets that most people invest most of their money in today actually lost money to inflation, each of them about -1% annual real return. The things that did really well are what we call real assets, commodities and real tangible things, gold, oil, real tangible things. And we think that's likely to be the case in the decades to come, not only because we think that the commodities and real assets, not excluding most forms of real estate, which is kind of a bubble, but we do think there's a super cycle coming in commodities that will likely see those as being very good asset classes to be in. We've been very vocal about our bullish view on things like precious metals and precious metal mining stocks for some time. It doesn't mean they go up in a straight line. In fact, they've been quite weak in recent days and weeks as interest rate expectations have become more firm, that the Fed won't drop rates as much as or as soon as was thought. So really interesting times. Now, I'm not going to say here on paper that we think the 70s is necessarily destined to repeat itself. There are good reasons why the 70s aren't a good analog, and there's some chart crimes being put out there where people are overlaying this recent spike in inflation with the early parts of the 70s, and there's some manipulation of charts to make it look like, hey, we're on the same path. But there are some reasons to think that could happen, and one of the key reasons we think is the policy response that central banks will likely continue to do, printing money anytime there's any material weakness in the economy or stock market. And we saw in the response to COVID that we've crossed the Rubicon, perhaps, in that maybe the next rounds of stimulus won't be QE and just flooding the market with base currency to bid up asset prices, but money into people's pockets where they can spend it on real things. And that's potentially the seeds of a real protracted and cyclical bout with inflation, like we saw in the 70s, for maybe different reasons, but we're not willing to rule that out. So I wanted to kind of bring this back to recent times and just kind of look at what certain asset classes had been done during the most recent spike with inflation, essentially from January 21 until June of 22. So I'm going to pull that chart up and some surprising takeaways here. So this chart looks at 4 broad asset classes, a proxy for cash in the form of 1 to 3 month treasury bills, the total stock market index as measured by a Vanguard ETF, and this is not an investment recommendation. None of these things are. This is meant to be educational and not personalized financial advice. A type of bond that is specifically meant to adjust or hedge the risk of inflation, so-called TIPS, Treasury Inflation Protected Securities, and then longer-term Treasury bonds. Couple key takeaways here. So once you can see that the actual return for cash was the best of all of these asset classes, despite the fact that during this phase, the yield on cash or treasury bills was essentially zero. The Fed hadn't really yet even started raising its interest rates material on things like money market accounts and treasury bills. So one of the big myths is that cash is the worst place to be during inflation. Over the long term, that is certainly an accurate statement, but during pronounced spikes in inflation, it can actually be one of the best places to be, as we saw it was there. Stocks did poorly, and even inflation-protected bonds that were supposed to be a hedge against inflation did poorly. They lost money, and the reason for that is because they're still a bond. Bonds were in a massive bubble after interest rates had been pushed way down on the bond markets, and so the negative aspect of being a bond in a bond bubble more than offset the positive aspect of the inflation adjustments. And then, of course, long-term bonds got hammered during that phase. Hopefully this illuminates some of the myths and confusions around inflation, but also some of the practical takeaways. It's not easy to be an investor and invest thoughtfully and prudently, especially when you have things like stocks at really rich valuations, near all-time highs on some of the most important metrics. And one key takeaway, stocks can be a very good inflation hedge over the long run, but if history is any guide, it's only when those stocks are priced at fair value or reasonable values even, that they can keep pace and offset inflation. As the big bear market in the early 70s will attest, 73, 74 bear market, stocks, when they're richly valued, can actually be very devastating things to hold in an inflationary environment, because that one of the first things that typically gets hit is market valuations, as the cost of inputs to businesses and consumers really slow down the economy. So we will obviously keep our heads in the game here, watching data, looking through this and drawing insights. And of course, we invite you, our clients and viewers, to reach out to us anytime about your specific situation. And I hope you find these videos helpful. We do them every week. And if I can invite you to hit the subscribe and like on our YouTube channel, it'll help you get alerted when we do send out new content. And for now, we just want to thank you for viewing, and I wish you a great day. Thank you now.